Hey guys, and welcome to the Insights Lab podcast. In this episode, we're going to mostly focus on the US markets and touch a little bit on the Fed's decision earlier this week and unpack how we think international markets are going as well. So we'll touch on that. This is going to be a massive episode. Brendan, tell me, what do you think about the US market at the moment? What's on your radar?
I think it's a little bit choppy as a reaction to Jerome Powell's speech. So obviously CPI data came out at 4%, which was 0.3% lower than expected, which is really, really good. Yeah. There was a lot of opportunistic comments from different financial institutions within the US and Jerome Powell. So one sentence he's saying, look, we're combating inflation and this is a fantastic sign for the markets. However, he went on to say that the forecast for the benchmark interest rate at the end of the year has been increased from 5.1% to 5.6%, which is obviously really, really bad. So, obviously the talk of the town was that they halted any more rises in the interest rate. They didn't hike it last round.
Yeah.
And, I'm a little bit conflicted on what to think about that. I think that, it's probably better to increase the rate, while we need it, instead of kind of prolonging this any more than it's needed.
Yeah, 100%. I think so. This is the first pause after 10 raises.
Yeah.
And I think the initial target was 5 to 5.25%. And, I think a lot of people were anticipating the decision on whether it's going to be a pause or whether it's going to be further raises, but I don't think it was completely unexpected. Most people were leaning towards fuck. Hey, buddy.
So we got a new guest on our show. Dash, what are your thoughts about inflation?
So with that initial raise, you were also mentioning earlier that they've now raised the benchmark target to 5.6%. Can you touch on that a little bit?
Okay, so in terms of what is the benchmark, or in terms of what I think about the overall?
Yeah, what do you think about that? So that's where does that put us? Like, how many more rate rises potentially will there be?
That's two more rate rises away, and I think it's contradictory to what is being said. So a lot of the financial institutions that came out, I'm not going to name what they are, but they're saying, it's a perfect time to get into the markets. I can't, really, holding true to, having the rates stagnant for now. Yeah. And they're saying, they're citing the US market's performance since last October. Yeah. And they're saying it's a good time for people that are sitting in cash to kind of get more invested with the markets. And I think that that's just a really bad decision. And you look at the motives of why they would be saying that, and I can't help but think it's for them to increase their own liquidity. Yeah.
Yeah, it makes complete sense. They've been talking about a soft landing for a while. And
I don't think in this situation there can be a soft landing. I don't even think that's doable. Yeah. Because at the end of the day, the longer this is drawn out, the worse it is for our own markets. And I think it's kind of better to kind of just get it over and done with. Yeah. This is something that a lot of people anticipated throughout the stimulus packages and, that aggressive quantitative easing strategy. I don't like how they can say one sentence and then contradict it in the next. Yeah. I think it's a time to be a little bit more cautious.
Yeah. Yeah, definitely. I guess on a positive note, we've started to see inflation come down, but what they're struggling with at the moment, and they keep referencing, is that the job market or the labour market and wage growth is still persistent and stubbornly high. So, that's probably one of the signals that they're looking at in terms of, as a sign of whether they should continue raising rates, especially if they've got a 2% target by 2025, which leaves us 18 months. So
yeah. Another thing, on the cards that I recently looked into was the inverted yield curve.
Yeah, tell us about that.
So with the yield curve, people, when it becomes inverted and there's a strange pattern happening, it indicates that short-term interest rates are higher than the long-term interest rates. And it's one of the predicting tools that they use to see if we're going into a recession. So we've heard recession being thrown around, and we've seen various countries, especially the latest one, New Zealand, that's now officially in a recession. I think that's definitely on the cards, and that's just a predict. Obviously, there's other things to consider in terms of employment, manufacturing activity, and business investment. But I do think that tool is true.
Yeah.
I think that the US will be in a recession over the next 3 months.
Yeah. Well, speaking of like New Zealand, they've been trying to tackle inflation for a while, just like the rest of us. And I think the UK is probably the outlier with they're saying that a lot of the citizens, they're not confident that the government is going to be able to get inflation under control. Have you seen like
absolutely.
inflation
I mean,
rates
the
there?
trust in government at the moment is pretty much at an all-time low.
Yeah.
And it really doesn't help that, when Jerome Powell talks about, that they're doing so good and this is such a good sign for the markets, and in the next breath increase the benchmark forecast for the end of the year by 0.5 basis points.
Yeah.
That's, I really don't know how to interpret it, but the market's a little bit choppy, and it seemed that over the last 2 weeks, the markets didn't really know how to react to that.
Mm.
So I think everyone's very, very confused. One indicator that I've been looking at, I've just been keeping an eye on the VIX, which is continuously dropping.
Yeah.
Which is a good sign. But
you were saying it's at the lowest it's been in, 3 years? Or?
yeah, I think it's over $13, but so it's still relatively high considering pre-COVID, the average was at 8.
Yeah. What's the implications of a low VIX or like a high VIX?
It indicates more stability in the market.
Yeah.
So the higher the VIX, it's also called the fear index.
Right.
So obviously it's pegged to the Chicago Board Options Exchange. A higher volatility means that there's a lot more fear in the markets, whereas a low volatility rate it indicates that there's more stability, which is obviously kind of what you want.
So in some ways that can be interpreted as the market is feeling like what's happening is predictable, like in the sense that, like inflation is coming down, and that like most of the gains are sort of expected. There isn't too much like going on where, there's a geopolitical, things going on like Russian invasion for the first time and, COVID, that would indicate a high VIX, right?
Yeah.
High volatility.
Yeah, I mean, we saw it run from $8 to, I think, the high of $81.
Yeah.
Through COVID when they announced lockdowns.
Yeah.
So, and I think we're still trying to get back to that, average. Obviously, with things now, it is going to probably stay at this level. I can't imagine the VIX dropping too much, just considering the confusion in the markets. And I think that the latest Fed Reserve update and the interest rates predicted to be hiked two more times by the end of the year is a very confusing time.
So another hike raise next month and the following month would probably keep the VIX still low. Like people wouldn't be that surprised by that, I imagine.
Yeah.
Let's talk about like what do you think could cause the VIX to spike? Like what could, like if we're no one's got a crystal ball, but what do you think it would take for the VIX to get back up to 40, 50 again? Like
in what time frame? Like in the next year, 2 years?
Over the next 12 months.
Over the next 12 months, I think that with new IPOs, so obviously there's a lot of talk about AI.
Yeah.
And although there's, it's going to increase the economic output for different nations, it's so important, it's so impressive, and it's a great story. There's going to be a lot of opportunistic companies throwing those buzzwords around. I think that venture capitalists are going to be chasing these high valuations, and I think that they're going to find exits via IPOs.
Well, one hot take is all the AI hype is already priced in potentially.
Maybe, but I mean, when we saw like the tech bubble in the 90s, right, all technology related businesses did really, really well. And that's what was needed to justify their high valuations, when they were, introduced into the public offering or had a public offering.
Yeah.
However, a lot of them really, it kind of took away from the merit of their implementation strategy and the merits of their own business. Like as soon as you say I'm a technology company and I'm in this space.
Yeah.
It was like no more questions were asked. Whether
Yeah.
you had a good plan, whether you had a good management, there's a lot of considerations that weren't taken into effect.
Yeah.
And I think that it wasn't so much that these companies that merited it didn't deserve a high valuation. They definitely did. I think it was the amount of companies moving in with the same high valuations that really kind of caused that crash,
Yeah.
because more or less they were exposed to the benefits of the internet and technology, but a lot of them really kind of overplayed that. And I think there's a huge risk with AI now. There are big, disruptive AI, companies coming out, and it's like ChatGPT, OpenAI, everything is looking pretty good. But I think moving forward, we're going to see a lot more of these plays being introduced, and I think that everyone's got to be kind of careful and kind of justifying those valuations outside of AI so disruptive. I see that as being a key point over the next 12 months.
Well, I'll tell you what would, spike the VIX. So I think if we have persistent, strong labor market in the US, but then we also have, an unexpected increase in inflation year on year, and we have that 2 months or 3 months in a row, like that,
absolutely.
That would throw, that would bring up or, cast some doubt in people's minds on whether inflation is going to resurge and whether it's still a headwind rather than a tailwind. What does that mean for, future decisions, and like, how's that going to impact a lot of these, especially for the mega caps? Maybe the rest of the market's already been beaten down, but, the mega caps that have most of them up around 20%, Nvidia has hit 1 trillion, is joined the 1 trillion market cap club. And that's probably a good segue into, sort of the mega caps outpacing a lot of the SP 500.
Yeah.
So I was reading earlier that, the 7 or 8 companies, Alphabet or Google, Meta, Nvidia, Tesla, Microsoft, right? And Apple, of course, the largest contributor to the S&P 500 index gain this year. The whole NASDAQ is up 15% year to date, which is massive considering like how rough last year was. And, when you put things into perspective that these 8 companies have made up the 88% or 90% increase in the S&P 500, it begs the question, like, what's the rest of the value stocks and what are the other sectors doing? We know the banks crashed early in the year. There's been no recovery there, or, it's kind of consolidating, but it's still looking pretty bleak. Where do you sort of see the US stocks sort of going over the next 12 months? Assuming that we stay around like that 5% or 4.5% over the next 12 months?
Well, I think that a lot of these companies that have outperformed, especially, the leaders are leading. I do think, their earnings have been really, really good. It's exceeded expectations. I think that there's been a lot of mania because of the AI movement in these companies and people realizing the importance, who are the big players, and they want to position themselves with the future leaders of that sector. I think that mania could die off. I think the overall markets, the money that we're seeing kind of drive the growth of these indexes. I think as we move on, I think there's also a delayed effect. I think there's a lot of people out there that are suffering at the moment just because of the interest rate hikes over the last 12 months. I think there's a delayed effect, and I still think things are yet to play out. It's pretty hard. We're in a time where it's going to be pretty hard to predict, 12 months in advance. Commodity prices, we're seeing a lot of volatility there. There's a presidential election coming up as well, and we always know that the VIX is historically spiked before every presidential election. The more controversial, the more everything's uncertain, and that kind of is reflected on the volatility index. It's a hard one.
Yeah, definitely.
At the moment, there is a lot of confusion, and the market seems to not know how to react. It's very, very choppy. It's all over the place, and I'm kind of reluctant to even be predicting these things at the moment. I'm paying attention, but yeah, as I said, 12 months is a long way away. And considering, they're talking in tongues at the moment, with everything's all good and it's a great
Yeah.
time to get into the market, but then having a horrible increase to their forecast at the end of the year for the interest rate, because the benchmark rate is going to impact all the different rates. It's a reference point for loan repayments, debt repayments,
Investment decisions.
investment decisions, and obviously in turn that fuels funding for businesses.
Yeah.
And a higher interest rate means it's harder to get capital, and it's going to impact the market capitalization. And I don't think the technology companies are exempt from that.
Well, look, on one hand, it's very easy to feel like we're going into a recession and like it's heading there, and we haven't felt the effects yet. On another hand, we've seen sort of these mega caps add another $2 trillion to the SP500 and the Nasdaq.
Yep.
Where else are we seeing this? We're seeing this in Japan. So the Nikkei.
Yeah, the Nikkei 225. It's really going. I still hold my forecast that it's going to hit 40,000. There's multiple reasons.
For reference, where's it at now?
It's over 30. I think it was 33.7 last time I checked.
Insanity.
Yeah, so it's really moving.
Why do you think the Japanese stock market is doing so well?
I think it started personally with Warren Buffett's transition.
Yeah.
So over the last 2-3 years, he's been, Berkshire Hathaway's taken a big position in some of the trading houses in Japan.
Quietly, really confident,
Yeah, and so now I think he's holding 7.4% equity in all 5 of them.
Yeah.
I think there's multiple reasons. Obviously, diversification. Japan's not really known for natural resources, so they're very dependent on these trading houses themselves for their commodities. For the imports and exports. I think that as they're further diversifying, it becomes more attractive. In terms of price to earnings, some of the businesses in Japan are operating at like maybe a 4-5x price to earnings ratio. And that's, one of the characteristics that Warren Buffett looks at compared to a 30x price to earnings on some of the businesses within the US. I think dividends are a big part of it. And another thing is, and this is something that I, recently learned over the last, couple of weeks. Everyone knows that China holds most of the US debt at the moment, but Japan falls in second.
Yeah.
And then recently with the talks about the debt ceiling, and that just seems to just keep increasing. I don't even know if there is a limit or if it's all just, it's amazing because, I think it's gone up. What is it? 70 times from what it was in the 60s or something like that. It's just absolutely insane. But I think that by Japan holding a lot of that debt will obviously benefit its economy.
Yeah. I feel like the Japanese economy was extremely strong through the industrialization process, like through the 80s and the 90s. And, all consumers were like, looked up to Japanese products as like very high quality, very high grade, whether it's electronics and whatnot. And they were seen as a very advanced society and the economy was very strong. And I feel like it was the US which, crushed a lot of that. And that's why the stock market has struggled to go up in a very long time.
Yeah.
And now I feel like, with the growing geopolitical tensions with China, the US and Warren Buffett are potentially looking at, two bad choices. It's like invest in, China, which we have bad relationships with, or do we, reinvest in Japan and make them a strong economy again? So I think it's kind of to the US, it's like choosing between the lesser of two evils.
Yeah.
But Warren Buffett calls a lot of the companies like wonderful partners, and he's had a big stake in a lot of these companies that have, he really likes the way they operate. And some of these companies are, I think Mitsubishi.
Yeah, Marubeni.
Marubeni.
Yeah.
And then there's one here which is Sogo Shosha, and this company is like the equivalent of like a Johnson & Johnson. Like it owns 5,900 companies and they operate across over 200 cities. So it just shows the sheer size of some of these companies.
Absolutely.
So it's really interesting. I think you mentioned, that Warren Buffett did sort of indicate that he wasn't going to increase his position size, in these companies beyond a certain point. Was that right?
Yeah, I think that when he started introducing and started investing in these businesses,
Yeah.
there were a couple of concerns from some of these businesses. But he pretty much, on a handshake basis, said that any more than a 9% equity share is kind of off the table. But he wants to work with them. He doesn't want to scare them and take majority. But I think that he spoke and introduced conversation to them and had that and was pretty encouraging with the dialogue. And as a response, they're happy with his investments, and he's letting his intentions be known earlier on.
Yeah.
And I think that's just good business. And the Japanese do seem to be pretty transparent people, pretty honest.
Yeah.
It's really interesting. And also, one thing to touch on when we're talking about the Japanese market is the change in attitude from the financial regulators.
Yeah.
Putting pressure on businesses to focus on their return on equity.
Yeah.
And that's been very different. I mean, over the last 20 years, or I think it was 24 years, the Japanese market has been in a point of kind of stagflation. Inflation's really never impacted it. And this is the first time that we're really seeing inflation impact the Japanese market. But there's other indicators like the producer index going down, which kind of illustrates, now we're seeing that effect, but there's a level of control behind that. And there's still measures they can kind of put into play to control it. And that makes it for a pretty healthy market overall. And I think that's one of the other considerations that Warren Buffett would have got into. He seems to be the first one to realize it. And we're already too late to the party. But it's really good to see the Japanese market doing well, considering the economy is in trouble. They hold the most debt globally, aging population, low birth rates. It's good to see something kind of really
positive.
Go into their favor. I really like
Well, if I recall correctly, I don't know if I'm making this up, but I think the central bank of Japan, they were one of the few that didn't raise interest rates because they didn't have the issue with inflation.
Yeah.
So that's obviously a benefit for their economy, and they're finally at a point now where they can increase their gross domestic output. Compare that to China, where it's been a story of high expectations of reopening, a lot of strength coming back because of, the end of the COVID lockdowns. But they're actually struggling. A lot of the headlines were anticipating China's resurgence to be a net positive for the rest of the, global markets. But we just haven't seen that. And, instead we've seen growing and raising geopolitical tensions between the trade things. Things are very tense at the moment. You've got people who have never been to Japan before, these high political figures coming over and having those meetings there.
Yeah.
And then we've got Warren Buffett that's completely sold out of his Taiwan semiconductor position, which he only, took on, and grew a massive position.
Was that solely
in the last year.
Geopolitical risk?
That was solely for geopolitical risk, and he feels like there's. He says that the US has done a lot wrong. China's done a lot wrong, but he's very diplomatic. But he's saying, his actions speak louder than his words, and him and Charlie Munger both think that the tensions are growing, the trade conditions are getting worse, and he doesn't see them getting easier sooner, anytime soon. And as part of that, he sold his entire position in Taiwan semiconductors, which is massive.
Yeah, absolutely. Things are about to go parabolic in Taiwan.
Yeah.
Being the biggest exporter and producer of the semiconductors, and especially
globally, they're the largest, right?
Yeah, the largest, and you need semiconductors.
Yeah.
For these AI systems. Yeah, so it's really, really interesting to see play out. Hopefully everything works out. But also with China's dominance. I mean, we've heard about, China's rise in power over the last few decades. But now you're seeing other countries that have massive raw material reserves and, play a massive part in global supply chains. I mean, China's the biggest importer of some of these raw materials. But you see places like Indonesia completely adopting an onshore policy, to build their own manufacturing state. I know through Donald Trump's regime, he wanted to create a manufacturing state in the US to lower dependency on China.
Yeah.
You got Chile already there that's adopted one. there's talk, Argentina might do it. And, there's a lot of things coming out to play. And China's definitely not benefiting from these onshoring policies being adopted globally. So it's something that I've got a close eye on. But, we'll see how it goes. But Taiwan's definitely, I'm happy that he made that move. It just shows how big and how things can change in terms of geopolitical risk. One thing that we've spoken about is the Congolese, and how geopolitical risks playing a massive factor. They're not, it's been known to be a little bit of a corrupt nation. No offense to anybody who's Congolese, but recently we've seen a lot of...
It's politically less stable, like destabilized.
Yeah, it's absolutely less stable. And we're seeing a lot of, one of the Australian businesses, AVZ over there, had their mining license pulled. They've pretty much done all their due diligence, ready to roll, and then that mining license kind of gets revoked.
Yeah.
And now they're into the international courts for the ICCC.
Yeah, it's fascinating.
Absolutely.
Look, let's change gears for a second.
Okay.
Not on the markets, but I wanted to add this segment where we talk about like what's something like you're watching, reading, or listening to at the moment. What's what do you recommend for the audience to watch, see, or listen or read?
One thing that I've been keeping a close eye on, like outside of like educational materials and whatnot.
Oh, it can be anything. Yeah.
Tesla's move recently.
Tell me about that.
Recently a $7 billion wipeout on the market against the short sellers. So obviously they announced earlier in the month, earlier last week, a relationship and a partnership with GM and Ford to adopt their charging stations.
Yeah.
And that's going to give them a pretty good footprint in the North American markets. And I think it was like 60% of the US EV market just as a response to that.
Yeah.
And one interesting statistic that I found was in 2022, and with all this kerfuffle with Elon Musk, shorters profited $12 billion in that year on just shorting Tesla.
Yeah.
They're now at a $12.68 billion loss this year, and a lot of that was just due to the recent announcement. So, that's something that I've been following. Outside of that, I've been kind of spending my...
So if you're listening to this, don't short Tesla.
Yeah, never short Tesla. Never short. I mean, they should have
known. Don't short Elon Musk.
Never.
Unless Elon dies, and then
absolutely.
Maybe you can short Tesla.
Touch wood. But outside of that...
resources, books, podcasts.
Look, I've been
what are you
doing
watching? What are you reading?
I've been learning a lot about geology, geochemical sampling, and
in the context of understanding mining.
Understanding resource stocks. So there's obviously with mining companies, there's a lot of considerations to make, and even to predict it to be economically viable. There's a lot of things that take place just outside the resource itself. So obviously, if it's got a big enough resource, the market looks at it favorably. But you've got to construct the mine. You've got to, you have to talk to engineers. As the commodity price, is fluctuating as well. Some of the feasibility studies that happen, may not be applicable or valid in like 2 years' time, just based on the volatility.
Yeah.
And that's kind of where I spent my time recently, just learning a little bit more about the tectonic environments. And some of the jargon just involved, like with geochemical sampling. What does that mean? Why that's important? Because me and you have spoken a lot about the Lassonde curve recently, right? How it's a pretty good way of not just understanding the life cycle.
Is that French?
Pierre, I think Pierre Lassonde. It's got to be French, right? I'm going to call it French. Yeah. Absolutely.
Well, while you've been, looking at, these different mining resources and getting stuck in metallurgy reports and this sort of stuff. I haven't been as busy. I've been watching, Spider-Man, which was really good across the Spider-Verse.
Yeah.
And also I think Black Mirror is back on Netflix, new season.
Yeah, right.
I watched a couple episodes. So far, I'm pretty impressed.
What's that about?
Black Mirror, you haven't seen it?
No, I haven't even heard of it before.
So it's how do I say this? You're just gonna have to watch an episode, and we'll talk about it next time.
Yeah, okay, yeah, done.
But outside of that, I've bought a book called Psychology of Money I think
Right,
it's
okay.
who was it again? Morgan Hansel, I think.
Okay.
And it's meant to be a really interesting book that just talks about like why people more around like the actual psychology and like people's relationship with money.
Yep.
And it doesn't read like a lot of other financial books. It's more of a something that whether you're into the markets or finances or not, everyone can benefit from. So it's more like story written, but
Okay.
even if you are, there's something to take away from it. So that's something I'm reading at the moment. I'm finding interesting, but I'm just one chapter in.
Yeah, absolutely. Let me know how you go with that because, after I finish this mining course,
Yeah.
I'll be looking into doing a little bit of financial modeling.
Yeah.
But yeah, look, I need better books.
Sounds good.
I've gone through the last one that I did was on the Wyckoff theory,
Yeah.
and I think I was reading a book called One Good Trade.
One Good Trade. Who's that by?
Mike Belafalor.
Yeah. How was
Right.
that? Tough to digest or?
I wanted to be able to kind of walk away from that book and take more action on the markets. It was more some interesting stories, but it was more people related. Like I knew this person that's done really well
Right.
and his characteristics and why I think he's done well,
Yeah.
as opposed to more actionable
Okay.
processes. And that's kind of why I wanted to kind of get into it.
Yeah. What are the golden nuggets that you can take away and implement?
Absolutely.
And
Yeah,
it felt like there was
absolutely.
more
So-
analogies. Yeah.
So look, in a way, I was a little bit disappointed with it.
Yeah.
But
Well,
all credit
there's-
to him. He's a very, very good trader, and there was a lot of stories that were digestible and good to hear.
Yeah.
But I went in thinking that it was going to be a little bit more technical,
Yeah.
and yeah,
Well, look, there's a ton of classic books that we can recommend, but I think like in this segment, we can make this this section about like any books that we've read like since the last podcast or during that week,
yeah.
or like any sort of episodes that people should check out. Any like new content creators that you're following or
Yeah, absolutely. So
guides and stuff.
I've been
Yeah.
following Money of Mine, which is a relatively new podcast on
Wait.
the Australian domestic markets.
Spotify,
Yeah.
Yeah.
I've just been watching it on YouTube.
YouTube. Yeah.
But I really think it's important to get behind those guys because they come from different angles. So one's a former equity analyst.
Yeah.
The other one's a former investment banker, and the other one actually was working in the mines. So collectively, and I love the way that they kind of break things down. They're really on top of things.
And they're based on, they talk about the Australian mining
market, yeah.
Yeah.
I think they're based in WA.
Yeah.
So I've been keeping an eye on those podcasts. I've learnt a lot from them recently. But in terms of educational, resources that I've been really looking at, I've been reading a book called Mining Essentials by Rob Stevens.
Yeah.
I found him looking at some of the YouTube podcasts on mining stock education.
Yeah.
Mining Stocks Education by Bill Powers. I saw one of his interviews and I got a lot from it, and now that I'm kind of like referencing all my entries based on the Lausanne curve, the different phases. So just before the discovery and just when a company goes from development into operation, those are the two entry points. But in order to kind of predict if there is going to be a discovery, you've got to adopt different perspectives beforehand. So geochemical sampling, geophysical data sets,
Yeah.
and have a pretty good understanding of geology, because with those three, there could be some advantageous signs earlier on.
Yeah.
And so that's kind of where I've been placing my attention.
Yeah.
But I think in order for me to fully understand the economics behind a mine, I think that I need to do a little bit of financial modeling. I've done a little bit in the past,
Yeah.
but not in that way. I think that there's a segment in financial modeling looking at sensitivity analysis, and that's kind of looking at the differences in hypotheticals based on the change in the spot price. And I think that based on volatility within those commodity markets,
Yeah.
I think it's more important than it's ever been.
Yeah. Cool. Well, look, I think we'll leave some of those resources that we've mentioned that you've looked at so people can go away. They're pretty complex, but if you go out and check them out, like you can get a better understanding of that. And we'll definitely be talking about mining resources and, more tools and,
there's a couple of things on the watch list at the moment,
sure.
and we're just vetting at the moment. So I can't wait to bring that to everybody.
Yeah.
But at the moment, yeah.
Sounds good. Well, thank you guys for making it this far. We've got a lot more on the agenda, and this is our first video podcast. So shout out to the video podcast. Now, I hope you guys enjoy it. We're going to wrap it up there. Thank you so much for listening. We're obviously starting and growing. So if you guys can leave a comment on what you liked, what you found interesting, or your thoughts, hit the like button, hit subscribe, and help the algorithm share our content. Thanks, guys.
Cheers.